Hello everyone. In this video I will be discussing International Accounting Standard 36, which deals with asset impairment. IAS 36 requires companies to test for impairment of property, plant, and equipment, intangible assets, goodwill, and investments in subsidiaries, associates, and joint ventures. International Accounting Standard 36 does not apply to inventory, construction in progress, deferred tax assets, employee benefit assets, or financial assets such as accounts and notes receivable. Under International Accounting Standard 36, a company must annually assess whether there are any indicators that an asset is impaired. Some indicators are a decline in market value, an adverse change in technology, markets, economy, or regulations, or the asset could be obsolete, damaged, etc. If there's a sign that the asset might be impaired, then a formal impairment test will have to be conducted. And this is accomplished by comparing the carrying value, in other words, the net book value, of the asset with its recoverable amount. The recoverable amount is the higher of net selling price and value in use. Net selling price is the price of the asset in an active market less disposal costs. Value in use is computed as the present value of expected future discounted cash flows from continued use of the asset over its remaining useful life, up to a maximum 5 years. If the carrying value exceeds the recoverable amount, then the asset is impaired, and the company will have to recognize an impairment loss in income. However, if the asset is carried at a revalued amount, the impairment loss will first be taken against the revaluation surplus, and any remaining amount of the loss will then be taken against income. The treatment of asset impairment under IFRS and US GAAP is different in important respects. One of the important respects has to do with the test of impairment. Under US GAAP, an asset is deemed impaired when the carrying amount exceeds the future undiscounted, as opposed to discounted, expected future cash flows from continued use of the asset and its disposal. Net selling price is not involved in the US GAAP test for impairment. When value in use is the recoverable amount under IAS 36, an impairment is more likely to arise under IFRS because of the use of discounted cash flows than under US GAAP, because US GAAP uses undiscounted cash flows. The measurement of impairment loss differs between IFRS and US GAAP. Under US GAAP, impairment loss is measured as the amount by which carrying value differs from fair value. So fair value can be determined by reference to quoted market prices in active markets, estimates based on the values of similar assets, or estimates based on the result of valuation technique. So it's unlikely that fair value and recoverable amount under US GAAP and IFRS respectively will be the same. At each balance sheet date, companies using IFRS should undertake a review to assess whether impairment losses have decreased. Under IAS 36, paragraph 14, prior period impairment loss for an asset other than goodwill shall be reversed if and only if there has been a change in the estimates used to determine the asset's recoverable amount since the last impairment loss was recognized. So what are some examples of changes in estimates? Well, it could be a change in the basis for recoverable amount. It could be that if the recoverable amount was based on value in use, a change in the amount or timing of estimated future cash flows or in the discount rate. If the changes in estimates criterion is met, then the carrying amount of the asset will be increased to its recoverable amount, but not beyond what it would have been if no impairment loss had been recognized. And the reversal of the impairment loss should be recognized in income right away. So this is another key difference between IFRS and US GAAP, because US GAAP doesn't allow for the reversal of a previously recognized impairment loss.